Credit card giant Visa also on deck to report fourth quarter earnings after the bell. Let's take a look at the stock ahead of the news. The thinking on Wall Street as Visa moves higher by just about 0.25% is that anything with an interest rate could do well in a rising rate environment. And that's what the futures markets are betting on. Not 3, not 4, but now Fed funds futures traders indicate the odds are now in favor of 5 rate hikes this year. KBW President and CEO Tom Michaud joins us now on the names he expects to benefit. And before we even get to that, first, Tom, Jay Powell left a lot of this up to interpretation, but this is your bailiwick. Did you hear a 100% chance of a rate hike coming in March?
We did. We think it's very likely. We have not modeled that. We've not put that into our earnings estimates. We actually, previous to this Fed meeting, were using June for when we thought we were going to get liftoff. But we believe, and I believe, we thought he was pretty clear in conditioning the market to get ready for March. So we haven't changed estimates yet for that. I think we'll wait for it to happen, but that's a possibility for a positive surprise for our earnings estimates.
And how can the markets absorb that? I think there's a misnomer or an incorrect belief that stocks cannot do well in a rising rate environment. I mean, does a 0.25% rate hike really make the cost of capital so expensive that it could somehow derail the economy? I wouldn't think so.
No, and I'm a believer in the discounted cash flow model for picking out stock prices over the long term. And clearly, as rates go higher, that'll impact the model. But a 0.25 point shouldn't drive some of the volatility that we've had. What I really think is it's a little bit more big picture, which is we just went through probably one of the most unprecedented stimulus moments of our lifetime, both from a monetary policy perspective and a fiscal policy perspective. And now it's behind us. So the market has to adjust to that new environment. And remember, it's of course, we're talking about rates going higher, but we're talking about rates going higher from zero. And we're also talking about removing extraordinary measures. And so I don't think it should be unreasonable for that to happen. And I think investors should have known that we weren't going to continue to get those emergency measures forever.
Okay. All right. So that in play, if that is the scenario, what does well in this environment? People say, oh, well, the mortgage lenders would do well because they will be reaping more when it comes to higher interest rates. Some of the financials, what do you see ahead that could really benefit in this atmosphere?
So companies that are spread dependent are beginning a period now where they're going to see accelerating revenue growth. I heard you speak in a prior segment about how earnings have been strong, revenues have been strong. Banks are going to start to see accelerating revenue growth because generally the banking industry was not built for zero interest rates. So as interest rates go up, they're going to have an opportunity to earn more typical spreads. And so we believe as we go into 2023, you're going to start to see double-digit revenue growth out of the banks. And so we like the banks that have more spread lending and a little bit less non-interest income or investment banking. So that's why we're emphasizing more of the regional banks than we are the big money center banks. But I do want to tell you that there is some concern in the market, and here we are, the Fed hasn't even started yet, but there's concern in the market that the Fed's going to go too fast, go too far, we're going to have a recession. Well, credit quality is always something that is a big concern for banks. It's our opinion that we're nowhere near that. And I'd also call out to the market that the shadow banking industry has taken a lot more of the riskiest assets than in prior cycles. So I think the big story of COVID is how good the credit quality was. So the industry enters this moment in really good shape from a balance sheet perspective, and the spread lenders that we think are going to have strong earnings per share momentum.
Well, then what would that mean for the credit card companies? We're getting Visa after the bell, but there are a bunch of others. There's obviously Discovery. Apple has its own credit card. You've got MasterCard, for example. Do you like any of those?
So we do like the credit card companies, but I'll tell you, right now, KBW probably has a greater percentage of banks with a buy rating on it than I can ever remember. If I were to prioritize, I would look at, I'll tell you, the bank to watch on the close today is Western Alliance. This company has beat expectations 17 of 19 quarters in a row, trades at 9 times earnings, and has had one of the better growth paths of any bank in terms of growth in the balance sheet and earnings and profitability. It's more of a traditional lender. I would focus more there than the credit card companies. Doesn't mean we're negative on the credit card companies, but it's more of a traditional spread lender. A company like that, or a company like Cadence Bancorp in Mississippi, which trades also about 9 times earnings. These are double-digit growers. Stocks have come off a bunch with the banks in the market. They're more traditional commercial banks, and we would say in the wheel, that's a good place to be. With regards to Visa, though, we think that the payment stocks are still a good spot. Now, there are different types of companies. They're not balance sheet lenders. Visa and MasterCard run the networks in the country. We like them for different reasons because we think that this move to digital is not going back. So we believe that you had 5 years of progress in just 2 years on the digital uptake, and that's the play for those stocks.
Tom Michaud, it's great to have you. I think, what I'm really getting out of this from the crucible is that you have a lot of buys on the most banks you've had in a long time, at least that you can remember. So we'll be watching all of those. And Western Alliance, by the way, down 2.8%, but still up about 59% year over year. Thank you so much, Tom.
Be well.